Okay, I'm now recording the meeting. Okay, our disclaimer, everything we're talking about today is purely for educational purposes, not giving any trading suggestions or recommendations, but just basically showing you how myself and Becky, how we go about profiting from the markets using options. All right, so these are the sectors we trade with options. And what I like to do usually when we start these meetings is go over a big picture view of the market, see where we're at from a monthly point of view, as opposed to all the chatter you hear on TV, radio, social media. So objectively looking at things from a big picture point of view. So I'm going to switch over to the monthly charts right now to get a big picture view of the markets. I'm going to change the share. All right. Anywhere along the way, if you have a question, just unmute, ask a question. If you raise your hand, I probably won't see it on the Zoom. So just, like I said, just unmute, ask a question, or you can type it in the chat window and I'll eventually see it. But ask questions at any time, pretend we're in a live actual meeting in person and treat it the exact same way. All right, so what we're looking at here is a chart of the S&P 500 going back to 1998. The blue line is a monthly 40-period moving average. You're going to see a 40-period moving average, whether it's daily or monthly or weekly, on just about every chart we use. How we started using the 40-period moving average was from Oliver Velez many years ago. Attended several of his workshops, and he had a 40-period moving average on all of his charts that he used as a line in the sand to help determine trend based on the position of the 40 compared to price. So we just started doing it, and it's worked really, really, really well for us. So you're going to see a 40-period moving average just about every chart we have. So there's a monthly chart of the S&P 500 where every candle is 1 month of time. Okay, so this is 1998 December, and we're above the 40. We pull back to the 40. Two closes below the 40 usually tends to have a deeper drop. This was that big crash in 2001 where the market dropped. Okay, and we rallied back up above the 40. That happened in 2003. We're back above the 40. And since then, we have a massive uptrend above the 40 for years and years and years. And this was our debacle in 2008 with the financial markets crashing. Once again, 2 consecutive down months closing below the 40, followed by a deeper drop. This was all the 2008 drop. Okay, right through 2009. This was the bottom in 2009. When the market started rallying back up and got back above the 40. Since then, every couple of years, the market pulls back to the 40. And as it's pulling back, you'll hear the folks on TV and media freaking out. The market's dropping forever. It's going to go down forever. But every couple of years, it pulls back to the 40. Years go by, massive uptrend, pulls back to the 40. A couple of years later, just massive, it just pulls back to 40 and then continues the uptrend. This is the 40. This is the way. This is 2017, from 2003 to 2017. It's except for that period in 2008 when it dropped for a few months and right back above the 40 in 2009. So now in 2017, still a massive uptrend. 1 month pull back to the 40, right back up again. Okay, but during these pullbacks is when you see the folks in media just really trying to scare you. They will tell you the market dropped 10%. It's now in a bear market. It dropped 10% right to support and then took back off. 10% is basically nothing as the markets have increased in price. Once again, this is 2020 when everything shut down. The beginning of 2020 with COVID, everything shut down, and we had this. This is literally a 3-week pullback. The markets pulled back for 3 weeks, and it was just a massive, fast, hard pullback, freaking everyone out. Once again, they said, well, the market's dropped 10%. Let's take a look at this. It's from 324. You see the pricing in the data box here and on the right side. It dropped from 320 something all the way to 220 something. Okay. So they said, we're in a bear market now for 3 weeks. Pull back to the 40, close right back above it. Don't be scared with we're in a recession. We're in a bear market. Who cares? The charts tell you what you need to know as opposed to the folks on TV and media. Once again, a few months back last year, the markets pulled back to the 40, closed right back above the 40. And here we are and are still in our continuing massive uptrend. When it got down here, people once again were just freaking out. The market's going to go down for no. Every so many months, the market pulls back to major support levels. It's just natural market flow. So don't let media just freak you out. So if you look at the big picture, so when the markets pulled back to these levels and we were getting new buy signals on the daily charts, it's like even better because knowing we have long-term support at these levels, and then on the daily charts, we get buy signals, is a really, really good chance that we're going to get a nice rally off these levels, which we did. And it's been a really good year so far on the long side of the markets. And short side too, but all right. So this is our big picture. So now we're going to switch over to the daily charts, and then I'm going to go back to the handouts briefly and talk about knowing when to go long and when to go short, and why it's so important to be able to trade very consistently and very consistently profitable by focusing, our strategies accordingly. Share. Okay, and I'll come back to this in a moment. I'm going to go back to the handouts now. So I'm going to trade. Let's see, back to the handout, S&P. Okay, so like I said, any questions you have, just unmute and ask it or type it in and I'll get to it. Say 40 EMA or weekly, it's 40 SMA, the simple, so raw is 40 SMA, not EMA. And it's an indicator of trend. So we can use it for support, we can use it for resistance, we can use it for defined trend. So we use it in all three of those ways, for support, resistance, and trend. More often than not, we use it for trend to determine whether the markets are going up or down. That's our primary use for the 40 SMA, not the EMA. All right, so now, so once again, these are the sectors we trade with options. These are the only sectors we trade with options. We chose these specific ETFs because they have enough liquidity on the options to accommodate our trading. There are many other ETFs that represent these same sectors, but there's only maybe 2 or 3 option contracts being traded a month or something. So we can't use those for trading options. We can use those for buying shares, but not for trading options. These are the ones we use for options because there's enough liquidity with the option volume and open interest to accommodate our trades and our trading size. People who want to trade really big trades, well, there's a smaller subset like the SPYQs and a few others that can accommodate really big dollar traders. All right, so scrolling down a little bit. I had put this together a couple of years ago, and it's also on the homepage on our website. But this is a picture of the Qs from 2020. And I just identified with arrows each one of our valid trades for the year. And it came out to 41 trades and 3 losses. That's 90-something% wins. I did this just to create a visual. So because usually you can't appreciate things until you get a good visual representation of it. So I laid all the trades out on the physical chart graphically so people can see what it looks like to commit to trading one symbol and how effective it can be. There are people who trade out strategies, but they try to trade everything. And when you try to trade everything, you don't get the most out of it. If on our trading plans, it says there are 92% wins with this ETF, with this strategy, then the best way to get the most out of that is to trade that ETF and try to take as many trades in that particular ETF as possible to get the most out of it, as opposed to jumping around with this one, that one, the other one. Focus on a subset of ETFs and you really do get the most out of it. And you can actually cut down on some losses also. And I'm going to take a look at that in a little bit, but this is kind of what it looks like visually to be able to trade one ETF over a year and specialize in it. I had put this together particularly because of one individual, this one person who I was working with, who I was coaching, only wanted to trade the Qs and nothing else. He didn't want to trade anything else whatsoever. So I told him, okay, we have 28 ETFs. If you don't trade anything else, you're only going to have maybe one, maybe two trades a month. Don't you want more than that? And he was like, nope. That's all he wants is the Qs, nothing else. So that's exactly what he did. He traded the Qs and absolutely nothing else. So whenever a trade on the NASDAQ on the Qs became valid, that's what he did. He would take the Qs trades and nothing else. That was his one specialty. And the NASDAQ is one of our favorite things to trade. We have great results on every single strategy with the NASDAQ. But this is what this person wanted to do. So that's why I put this together, just to create a visual. And it's a good visual. We catch market tops, market bottoms, but as long as you're consistent with your trading, you might have 3-4 trades on at the exact same time with the same symbol. You just manage them, and it's just cha-ching, constant positive cash flow. And you just trade size accordingly based upon your account size so you never over leverage your account. Generally speaking, it's 2% account risk per trade, but if you're only trading one thing, you can go higher than that and get a very nice return on your money and on your account, right? Really focusing. So what I did today was go through, I chose S&P 500 and oil, USO, as two examples of knowing when to go long, when to go short. And that is utilizing our grouping of strategies. We have a group of 6 strategies on our daily charts, plus our weekly chart strategies. And when traded in conjunction, they're going to look like the chart we just saw, where you're going to get buy signals at the bottom of markets, because we literally have buy signals for the very, very bottom of a market. We have buy signals for once a market has started turning upward. We have buy signals for when a market has established a trend. We have sell signals for when markets are at the very top and rolling over. And we have sell signals for once a market has rolled over and is now trending lower. So we have different strategies to catch markets at different points in time, as it's trending up and as it's trending down. You cannot find one strategy that trades everything at every part of a movement. That's not realistic. The strategy that shorts market tops will not be the same strategy that gets you in when the markets are trending lower. It's just a whole different type of approach. In either case, we average 84 to 90-something% wins with each strategy. But this is why I wanted to lay this out, to see why it's so important to have specific strategies and to know when to go long, when to go short, and not just wing it and guess. We don't guess. The strategies tell us exactly what to trade and when to trade it. Then I'll go back to the charts and show you how to identify one of the strategies and how to actually maximize profits on it, or how to take trades where you get a lot more profit than you would initially expect to get. All right. Again, stop and ask me with any questions you might have. Okay, so here's an example of SPY. This is from 2021. We had a total of 27 trades on SPY. and 93% wins, 7% losses. So 25 wins and 2 losses. That's for the whole year of 2021. That is trading the S&P 500 SPY ETF. If you were to take every single trade, you won't be in every single trade, but the goal is to try to be in as many of them as is financially realistic for you. People who have a bigger account will end up doing better trading because they literally can afford to take all or most of the trades. People with a smaller account have to be more selective. So like the old saying goes, people who have more money can make more money. People who have less money, well, you're not going to, you can make money, but you're not going to be as successful from a profitability point of view, percentage-wise, as someone that has a much bigger bankroll, okay? But you can be profitable, but you don't get the exact same results as someone that has a bigger bankroll. That's just the way it is. However, there are things you can trade. SPY might be out of someone's price range, but there are other ETFs that are much more reasonably priced that can accommodate smaller account sizes. Let's see, how big as in the 2 losses wipe out the 15 gains? Okay, James. So we don't know how much you're going to make on an option trade. How much you make on an option trade will be determined by where you got into the trade. If you do nothing but enter at the open the day after trade is valid, then you will, the way the numbers work out, you're going to need at least 5 wins to offset 1 loss. It could be less, but you have to plan on it. It also depends how you choose to manage it. If you do nothing but go for a first profit target and grab your money and go, great. But if you want bigger returns and you manage positions, trail stops, then you get bigger returns. So you should plan on 5 wins to offset 1 full loss, but it might be less, but plan on that. That's why we average 80, realistically, we average 87 to 90% wins in most cases. But 5 wins to offset 1 loss is what you should expect with option trades. But like I said, personally, I get a 20 to 60% return on option trades because of where I get into the trades. That would require 2 or 3 wins to offset 1 loss. Depending on your personal habits, whether you get up the next day to place your trade or you get in a more it all depends on you and your personal trading habits, and when you place your trades and how you go about it. Managing it will determine how many wins are needed to offset losses. But and I'll go through. Thing is, when we're maintaining this much wins, it's hard to lose money, so to speak. It really is hard to lose money over a period of a year. You might have losing months, but I'll talk about that a little bit later too. Along with 80-something% wins, as long as you're consistent, you will end up making money. If you do the absolute minimum amount of work, you're looking at a 10 to 20% return on your account for the year. That's risking 2% of account per trade. If you want to get that 20 to 40% return on account annually, then there's more work to do. Then there is being more smart as to when to place trades to get bigger profits. So the more relaxed you are, the more money you will actually make. The more time and effort you want to put into managed positions, the more money you will actually make. So it all depends on. So we have a lot of control over certain things. It takes a little while to kind of find our sweet spot. Like I don't get up in the morning to place trades. I place trades when I get to it because I end up with bigger profits, but I'll talk about how I do that in a little bit. So here's SPY in 2021. I also pulled up US oil. So if you want, for people, I know a lot of people like to trade oil. So this is US oil in 2021. Okay. At a first profit target, in most cases, at a first profit target, we're looking at a 5% to 25 to 30% return on your risk dollars. So if you risk $1,000, you're looking at a 5 to 25 to 30% return on that at the first target. That's doing the minimum amount of work And that 25 to 25% in my case is up to 20 to 60% because I get in at a much better price than is minimally required. Okay. So that is US oil, and then did it for 2022 SPY to get 90-something% wins. This is taking all the SPY trades. Our strategies are pretty straightforward. You're either looking for 2 lines to cross or color to change or a line to go down and go up. It's a very visually easy way to spot trades. And if you are good with programming, then you can actually write a program for your trading, your analysis platform to identify the trade setups for you. Remember, the setups and strategies, they are meant to find the opportunity. You do not make money with a strategy. You do not make money with technical analysis. You make money by knowing what to do and how to manage positions after the opportunity has been found. So after you find a valid trade, you don't just magically make money. You actually have to know what to do. You actually have to know which option to select. You have to know that you are not buying option at a price that is too expensive. You actually have to know you have enough time in the option. You actually have to know how to enter the trade and where to enter the position. You actually have to know how to exit the trade and how to manage the position at or beyond the first target. So the strategies is the foundation to find the opportunities that can give you a 85 to 90-something% probability of having a successful trade. But from after that, you actually have to know how to do, and that's what I work with people on. And the people who are most successful are the ones that stay in communication with me and have me review their trades each month, especially if they have losses, because a lot of times people are trading and they start getting losses and they think it's the system is bad, something I told them is wrong, it's not working, and they blame everything else except themselves, when it's actually they're just messing up and they don't know it, they're messing up. Okay, so that's why I really, really encourage people I'm coaching to stay in contact with me, have them review their trades each month, especially the first few months, because you might think you're doing it totally right and you're not. I've had people do amazingly interesting things, and they didn't understand why they were getting such different results until I went over it with them, and they was like, oh, I missed that one thing. Or they'd never move their stops on the remaining contracts. There was one person that was literally averaging 90-something% winning trades. It went for months, literally about 92, 93% winning trades. It all hit the first target, hit the first target, hit the first target, hit the first target, loss, net loss. And he thought he was doing everything right until I sat down with him. Okay, so you move your first target. Okay, you put the first target there. Okay, great. And you sold half your position or 2/3 of your position, the first target. Okay, and okay, where did you put your stop loss on the remaining contracts and your second target? And he was like, what? He had totally forgot about the stop loss on the remaining contracts. He put in a second target. So the first target is so many points, great. It sells the contracts automatically and puts money in your pocket. But he had totally forgot to put in, with your remaining contracts, you need both a second target and a stop loss. So if the market goes down against you, it will stop you out of the remaining contracts and lock in whatever profit you had at the stop loss. So what was happening, they put, like most people, they think about making money with the second target, but they don't think about protecting profits with the stop loss. They think about how much they can make, but don't consider the loss. So they would allow themselves to take a full loss on the second half of the trade. So they might make a 20% return on the first half of their position, but lose 100% of the second half, resulting in a net 80% loss of money. Okay. And they didn't realize that they literally didn't realize they were doing that, because they never, until they had me look at what they were doing. And then it's like, they just had a head scratch. It's like, why didn't I think of that? Because sometimes you need someone working with you to point that out to you, because it's simple stuff like that, that you might, especially if you're new or don't think about it, it's not always obvious to especially new people. So that's why I ask people to work with me, contact me, and let's go through the trades and fine tune what you're doing, because what you think you might be doing right might not be correct, right? So, and we don't want to turn a little loss into big losses. Here was 2022. 2022 was had a few more losses than some previous years, but as long as you're consistent with your trades, you end up making money. Okay, so take a look at this right here. In October, we had a couple of losses, and with a couple of different strategies. So these losses won't show up until December expiration, because we get it 2 months in advance. If a trade is valid in October, we're getting about 2 months worth of time. Okay, so those would be December up. So December is when these losses would actually show up. It's always 2 months later, 2 expiration cycles later. So each year for overall strategies, we're going to have 2 to 3 losing months each year. Even with 80-something% wins, you will have 2 to 3 losing months every year. Those 2 to 3 losing months will be offset by 2 to 3 winning months. The other 6 to 8 months will represent your profits for the year. It is quite possible to have 2 to 3 losing months you could have 2 great winning months. Let's say 3 great winning months. And then the next 3 months are losing months. And what happens to people, they get totally discouraged. All the money they made in 3 months is wiped out with the next 3 months. They lose confidence in the strategy. They lose confidence in what I was telling them. They lose confidence in themselves and everything, and they move on to something else. That's what people do. No, you have to keep trading. You have to keep trading. You have to trust the strategy, trust the methodology, and understand trading isn't making money every month. That's not realistic. If you think you're going to make money every month trading, you are not thinking in a realistic manner that has to do with most businesses, which don't make money every month. Okay. Remember, a lot of companies out there, they make money during certain holidays, and that's their big holiday time to actually make money. The rest of the time, they're treading water and just trying to pay the bills. They don't really make money till a few months each year. And this just like any other business. So if you had 3 winning months, 3 losing months, you start losing. It messes with your head. That's why you have to be in constant communication with me, because I literally become, after I show you be a trading coach, the rest becomes motivational coach to keep you going, because that's what it takes. It's just me trying to convince you, you got to keep trading. Yes, you got, yes, because you're going to think you're going to be losing forever and ever and ever, and you're not. It might just feel that way, but a losing month means you also have winning trades that month, which offset some of those losses, but just not completely offset every loss. So if you had 3 winning months followed by 3 losing months, the remaining 6 months are your profits for the year. Okay, that's your profits. It's easy to say that in a big picture point of view, but when you're actually living it, it's really challenging mentally, psychologically. They say trading is a psychological game. It is. You got to be able to sit through the losses, but know that you're doing it. As long as you know you're doing it correctly, you're following the plan, you're managing positions correctly, the numbers will work themselves out. Okay. So I think we have one more here for SP. Okay, this one is SPY and USO for 2023. Here's where we are right now for this year with those 2 particular ETFs. Okay. Now keep in mind, this is a full list of ETFs. I just asked Becky to put together. So anything you see in a rectangular box on a spreadsheet, it was done by Becky. She's my trading partner and co-host. She is a data manager by profession, so she is good at maintaining all of our spreadsheets and records like this. So anything you see in a rectangular box in a spreadsheet, she's doing it. I do not like to do, I don't write stuff in spreadsheets. I just don't. If trading required spreadsheets, I would never trade. So you won't see me spreadsheeting everything. I write next to my desk, I have a little pad with all my trades and entries and everything right here. And so I write all my stuff down, but I will not spreadsheet that. So I have all my, how many contracts I'm trading of what, my entries, my targets, I write all that stuff down. Some people like to do spreadsheets. I'm not a typist. I don't do spreadsheets, but I write everything down on my pad next to my computer for all my trades. Okay, so let's go back down here. So this is pretty much how we go about. No, we track all of this so we know what every ETF is doing. We update it every 3 months, and we send that out to all our coaching clients. Now let's go back to our charts. Let's take a look at some trades recently. Take a look at SPY on 126.23, Donchian cross, and 4523. So we'll look at those first. And this is the one strategy I usually go over. It's a simple one, but it's one of a very effective strategy, one of our best ones with the best win-loss percentages. I'm going to change the share. Again, any questions, just unmute and go ahead and ask or type it in. Okay. So this is a chart of the S&P 500. This orange line is a Donchian mean line. This is an upper Bollinger Band, and the blue line is our 40-period moving average. This is a daily chart now. This is the S&P 500, SPY. And one of the strategies we trade is a Donchian cross. And I've gone over this one in a couple of previous meetings. But it's literally when the orange mean line from the Donchian crosses over the 40-period simple moving average. If you take a look at the data box on the left side, you see the value of the orange line and the value of the blue line. Everything is, the colors on the data box match the colors of the indicators on the chart. Okay. So I just did have a question. Let's see, one was a big with the loss. Just a follow-up on James's question, how big were the losses? We always risk 2% of the account. So 2% of the account is a standard risk. If you want to do more than that, that's up to you, but 2% of the account. So we never have a big loss. Can't have a big loss because you're only risking 2%. And I'll go through, I'll show you a spreadsheet a little bit later on, but we never have any big losses. It's impossible. All right, so going back to the chart, when the orange line crosses the blue line, you're going to see the value of the orange value, the mean increase to be greater than the blue lines. Right now it's 390.70, which is less than 391.83. On this day, 392.17 is greater than 392.05. So you may not be able to see this with your eyes when the orange line is crossed. Exactly, that's why you have to use the data box to look at the exact number. Now, I need someone to pull out their calculator because I'm going to be asking you for a number. So anyone but Becky, pull out a calculator because we're going to be here until we get a number calculated. So some people get their calculators ready, or it's on your computer or your phone or wherever, have a calculator ready. We do not do option analysis. Our analysis is done on the underlying ETF. We use options in place of trading the ETF. Okay, so we gain massive leverage, and we're able to survive through the swings of the market without having to have a hard stop. Okay, the only options analysis we really need to basically understand is in the money, out of the money, at the money. And generally speaking, we're going to be trading an in the money option, first strike in the money, which is going to be usually a 53 to 60 delta option in that range. Okay, and it's going to be 1 to 3 months out in time, depending on the situation. It'll be anywhere from 30 days to almost 90 days worth of time. We just buy calls and puts, no spreads, and no spreads. There are certain types of trading where spreads are great. This is not one of them. This is pure, hardcore, directional trading, where if you put on a spread, you are putting on the wrong type of option strategy, the absolute wrong type of option strategy. For this type of strategy, we're doing this type of trading, we just buy calls and buy puts, not spreads, okay? When we do it with ETFs, we don't have the same type of issues with implied volatility that we do if we were doing with stocks. If we were doing with stocks, implied volatility can kill us with time decay and volatility crush. We don't have those issues with the ETFs. So it's really much easier to trade ETFs by just buying calls and puts with the approach we're using. All right, so, okay, on this day, ATR, the average true range, which is, and we use a 5-period ATR, which is basically, for those of you not familiar with it, it's telling us on average, every 5 days, the SPY moves $5.79 or 5.79 points, okay? So someone make a note of that, 579 is our ATR this day, 5.79. The very next, so here we get the orange line cross the blue line, and I'll let you know there's other criteria to qualify the trade besides the cross. It's all valid here, but that's what I go over with you on one-on-one with coaching clients, is because we use the Bollinger Band and the number of days that orange line is below the blue line. And so there are other criteria, but this one is valid. The next day, the market opened at 403.65. So write that number down. 403.65 is the open price the next day. What is 403.65 plus the previous day's ATR of 5.79? So again, what is 5.79 plus 403.65? Again, what is 5.79 added to the open the next day, 403.65? The Olga has it as 409.44. Okay, we'll assume that's correct. I'm not checking the math or anything. That is our first profit objective. Okay. The ATR is an excellent way to use, is an excellent way of determining a profit target, because we have a way of knowing how much this SPY actually moves. On average, it's moving that much every 5 days. So that is our measure of the volatility of the SPY on that day. That is how we're measuring volatility. On ATR is moving on average 5.79 points every 5 days. And our technical analysis was the Donchian cross. That is giving us direction. So the crossover gives us direction. We know after it crosses, after the Donchian mean line crosses the 40, we know that 80-something% of the time, the market will continue moving higher, at least one ATR, and that will happen within the next 1 to 2 months. We know that. So we have a trade signal that gives us direction, and the ATR gives us a magnitude of movement to use as a profit target. Okay. The open price the next day is 403.65. So we're going to use the first in the money strike, which is 403. So we'd be using a 403 strike. If this is in January 27th, then we'd be using either a March or April option, depending on the statistics and a business decision on the part of the trader, because we have statistics for 1 expiration cycle and for 2. The further out you go, the more you're going to pay up front, but you have a higher probability of having a profitable trade. the less time you have, you're going to pay less upfront. If you have a win, you're going to have a high percentage return, but you have a slightly lower probability of having it be a successful trade. So you got business decisions to make when it comes to it. So we give you all the stats. When you look at the stat sheet, it might say something like, if you go 2 to 3 months out, it's going to be 92% wins. But if you go only 1 month out, it might be 87% wins. Make a decision. And whatever decision you make, it's the right decision. But it's a decision you make. And you live with it. More time costs more, but you have fewer losses. Less time costs less, but you have more losses. So all depends. Usually people with smaller accounts go with the less time because it's cheaper, but that's not always the best decision. Sometimes it's better to suck it up and either wait for a better opportunity where you can afford an option with more time that fits within your budget. But that's something you have to trade for a couple of months and kind of figure that out for yourself by actual live trading. So what happens here now? Let's take a look at this. Let's say you got into this trade the very next day, you're up at the open, you got up, you're there at 6:30 on the West Coast, and you place your trade, you get in at the open or below, open price or below for calls, open price or above for put options. So for call, you're getting in at when the market is below, it's at or below 403.65. And you got a 403 strike. And our first target is 409.44. You see the high this day was 408.16. The high this day was 413. So you bought your option in the morning, and then 3 days later, your first target is reached. So how do you manage this trade? After you get your option, you have call options in your account, you simply put in an exit order to sell X numbers of contracts when SPY is equal or greater than 409.44. That's it, and walk away. There is no sitting there and looking at things go up and down all day. You just put in your exit order to sell either all your contracts or part of your position. If you want to do extra trade management, then you have extra contracts after the first target. But you sell all or part of your position when SPY is equal to or greater than 409.44. You put that order into your trading platform, good till canceled, go about having and living your life, okay? Nothing else to do. Back when myself and Becky were day trading, we were sitting there all day trying to do this stuff, and it was like, but like any other business, as you evolve in the business and grow in the business, you want to spend less. You want to be able to work less and make more money. And that's what we do. We started our day trading like everyone else, sitting there looking at daily charts and intraday charts, trying to micromanage positions. That doesn't work if you want to have a life and you want to get away from your computer. And we want to do that. We just couldn't sit there all day and look at stuff. There's that type of trading, and there's nothing wrong with it. But if you want to have a life in the long term, that's not a long-term approach to trading. You gotta, so we evolve so that everything we do is swing trading. Just put a trade on, whether you go to work afterwards, whether you go, like I go to the gym, I go to jiu-jitsu, I go teach classes, I work on films, I work with commercials, might be going on strike soon, apparently, with the Screen Actors Guild. But so I might have a little more free time again. But I work on different projects. I work with the city. I'm a city official in Santa Clara. So doing lots of stuff, keeping busy. But I don't have time for that stuff. You have to sit in front of a computer, okay? Trading is what gives me free time to do other things. It creates income for me, but it's income that I don't have to spend a lot of time trying to make. We all go to 40-hour-week job, but this is, you can make a really good income just a couple hours a week, even less, okay? And that's a great thing about trading, if you have the right approach that fits your personality and lifestyle. Some people really want to sit there all day and look at stuff, great. But if you just want to have a comfortable lifestyle, just make some extra money, this is a nice approach to do that. So if we got in right at the open, it gets hit a couple days later, you're looking at a fast move like this, you're looking at a 15 to 30% return at the first target, okay? Depending on whether you got 1 month or 2 months out, you know, it just depends on the time of the option. It's 15 to 30% return at the first target. If you had additional contracts, what you would do is you, after the first target is hit, you sell part of your position automatically, and the remaining contracts, you put a stop loss in that's above what you paid for it. And then you have a secondary target, which is probably hit on this gap up. So from 410 close, it gapped up and went all the way to 418. So it made a several ATR move. So there's a good chance you can double money on some of these gaps. But what you do is after this gap up, after this day is over, you're literally moving your stop loss up. So you might have protected 20, 30% of your profit on the option after the first target was reached, but then after the gap up, you might be protecting a whole bunch more of your profit on the option. So, or take the whole position off. You can be doubling. So it all depends what your second target is the flexibility on that. But you could pull down a nice 50, 60% return on this one trade with just the first and second parts of your contracts, depending on how you manage it and some decisions you make. Do you avoid weekly options when going out further? We can't use weekly options. We use we trade with the options that's been around forever, not all these fancy new things that came into existence in the last 15 years or so. All those weekly option stuff didn't exist 20 years ago. We use the third expiration Friday, the third Friday of the month. That's the only expiration we use. And that's it. That's the only expiration we use, is the option that expired the third Friday of the month. That's what's been around since forever. And that's how we can do all of our analysis and calculations based on the third expiration Friday of the month, third Friday of the month. So the Monday after expiration Friday until the following month's expiration Friday is one cycle. So if we say one cycle, that's how much time we have. If we say 2 cycles, it's basically 2 months. But it always starts from the Monday after expiration Friday till the next month's expiration Friday. That would be one full cycle of time. And that's how we calculate everything on time-wise. But we don't do weekly options. We have to go just that third Friday of the month option. That's it. All right, so that's sounds good. It's like you get a nice profit, but let's say you didn't get in that day. Let's say you missed a trade. Let's say you were sleeping, you went to work, you had other things to do, you don't get into trade. Okay, so the next day, as long as we're below the open, the entry price was 403.65. This is the day the trade is valid. This is the next day when you enter the trade at or below the open price. Well, let's say you didn't get in that day, you have other stuff going on. You can't be in every trade, you have a life. Hopefully, you have a life. You got other things happening. You got family, you got travel, you have work, you have kids, you have entertainment, you have a vacation, whatever. Okay, the next day, we're still below the open. So let's say just randomly, we look at the next day and the current price is 401.17. Okay, just happen to put my cross here, so 401.17. And you look at, you know, there was a trade valid 2 days ago and I didn't get into it. Let me see if I can get into this trade now. This is how most of my trades are in real life. I don't get into the next day's open. I'm never up at the next day's open. I don't do that. I'd be like, here, okay, let me check this out now. Okay, so back to the calculators. If I get, we know what the first target was because Olga calculated, so Olga has calculated it to be 409.44. Now, if I was getting in at 401.17, because that just happened to be where the market's at this particular day when I'm looking at it, I'd be looking at the 401 strike, which is the first in the money option. Up here, I would have been looking at the 403 strike, first in the money option. If I'm down here at 401.17, the first in the money option would be 401. Okay. Now, what's the difference between the original calculated price of 40944 and 40117. How big a difference is that? Again, what's the difference between 409.44 and 40117? Difference between 40944 and 40117. What's that difference? Someone type it in, please. Difference between 40944 and 401.17. Need someone to calculate that and type it in chat window. 8, Barbara, 8.27. Okay. Thank you, Barbara. And Olga, you was like a right tied. Okay. So here's what that means now. Here, the target, your target price, the magnitude of your target was $5.79. Okay. Like I said, I'd give you a nice return on your money at the first target. If I got in, let's say I didn't get in that day, but I got in here and I looked at, just happened to look at the market when it was lower at 401.17 and I got into the trade. Now, my first target is still my first target. That hasn't changed. Okay. My first target is still 40944, except now my profit objective is $8.27 as opposed to $5.79. Okay. I added 2 something to my profit target. 2 something or close to $3, whatever it might be, 2 something. So I have a much bigger, I know $2 and something cents to my profit target. Okay. Instead of my target being size being $5.79, my target price getting in 2 days later is now $8.27. That can translate, that can change my percentage return at my first target from being 15 to 30% return to being 30 to 50 or 60% return. That's how most of my trades are in real life. I don't rush to get into the open. There are people who get into the open because that's the way they want to do it. They want to get the trade over with, get it placed, and then go about their lives. No problem with that. And there are people who are more relaxed. They chill, they wait. They might miss some trades. They might open and go off without you. Well, you miss it, so what? Next trade. But the people who are just more chilled and relaxed, they come in, they missed the trade because there's other stuff going on. But the next day they had a thought opportunity. Oh, the market's down, let me go ahead and get in. Becky does a lot of these type trades also. She gets in on pullbacks. They become much more profitable. Becky does the same thing. She gets in at a later time when the market's lower than it was going to be initially. That's how you turn a 15 to 30% return into a 30 to 60% return. That's just at the first target. You can still manage this position beyond that. Okay. So this is the type of stuff we go over one-on-one in more detail, because you're gonna have to manage the positions. And if you have more money, well, it's smarter to manage it, but you may not have a lifestyle that can do that. So we have to, what I do is sit down with you, and either in person, if you're around Santa Clara, I meet with you in person, or do it via Zoom. And we customize an approach that fits into your personality. Personality is real important. Personality and lifestyle. If you don't get up until 7 a.m., you're not going to be placing trades at the next open. That's just not going to happen. Has to fit within your personality, your lifestyle, and financial reality. Just because you want to trade the SPY doesn't mean you're going to trade the SPY if your account is only $7,000. It ain't happening. Sorry. You're going to wipe out your account in 1 or 2 losses. You can't do it. Okay. And we're only trading in the money options. We don't, there's some people told me, well, we heard you can buy cheap out of the money options for like pennies. Yes, you can, but that's for a completely different type of strategy and different type of trading that has nothing to do with this. And so this is not that type of trading in any way, shape, or form. That's a completely different, whole new ball game that'll take you maybe 2 to 4 to 5 years to find your way, and totally different approach. The way we're doing it right now is kind of what we've settled into for many years now. Our approach to trading has not changed in many, many years, our approach to trading options. And this particular setup happens all the time. More recently, here it is on 4-5. I think it was 4-5. It's on the spreadsheet listing on the valid trade. Enter the open or lower. First target hit. Here it is on 2022, 11-4. Orange line crossed over the blue line. It's that simple. Enter at or below the open. Here is where we see the massive profits on the gaps. So when we see a gap up like this, all of a sudden, what you thought might be a 15, 20 something percent returns on a gap like this, your 15, 20 something percent can gap beyond your first target. And all of a sudden it becomes a 30 to 60% return at the first target. And then it keeps going. And if you have remaining contracts, just trail the stop, trail the stop, trail the stop, your options on remaining contracts double in price, sometimes triple. So a move like this with the gap and it just keeps going, those are beautiful trades with trailing stops, because your second half of your position can quickly double in value, get a very nice return on your money really, really fast. And you could have gotten into this trade on any of several days. So you had at least 3 days to enter the trade before it took off. And like I said, you see this trade over and over again. This one could be profitable. I have to do the actual numbers, but it only had 2 days to actually be profitable before it dropped. Another nice trade. Anyway, this is the Donchian cross is just one of several strategies which we trade. So this is the one I usually show during presentations. The rest I say for coaching clients. James, does this strategy work in all market conditions? It works when we have that valid setup. So can you clarify what you mean in market conditions? What do you mean? What is your definition of market conditions, James? Can you, if you want to speak, you feel free to. I'm just kind of curious what your definition is of market conditions, so I can answer you appropriately. Bullish, bearish, or sideways is a totally subjective thing, depending on what time frame you're looking at it, how much of a chart you're looking at. Is this, take a look at the chart right now, is that bullish or bearish or sideways? Take a look at the chart now, is that bullish or bearish or sideways? That looks pretty sideways, right? That's because that's just how much of a chart I'm looking at. So if I look at it now, oh, that looks kind of bullish. If I look at it now, well, that looks kind of bearish. If I look at it now, well, that looks kind of sideways. It all depends on how you look at a chart and how many bars you're looking at, and totally so I don't get into that. I never ever try to classify bullish, bearish, or, because that's so subjective, it doesn't work. That's why I go with the objective trade signals. So when I see, so that's why I'm totally technical analysis based. So when I see my valid trade signal happen, because we get this signal in bullish markets, we get this signal in bearish markets, and we get this signal in sideways markets. That's what's so great about it, is that it gives us the when. And so it doesn't matter whether it's, this is all sideways from my point of view. This is from my point of view, this is all sideways, right? But that's our buy signal, cha-ching, doom. Remember, a 180 on move isn't that big a move, but based upon the market volatility at the time, we know it's going to move 5 points, you know, and this just gives us direction of the 5 points. Okay, we know it's going to move On this day, it crossed over, it's $4.50. We know it's been moving $4.50. It just tells us which direction we should pick. So the technical analysis gives us the direction. The ATR gives us the magnitude of direction it's going to move in. So that's why we avoid now there are certain times when the market is trending harder. Cha-ching for us, because that's when we get paid, okay? If we get this market when it's in trend, or sometimes we get this market, most often this trade will come following a decline in the market, and then it starts to turn up, and then we catch the move. If you go to some of our big moves, let's take a look at this one here. This is in a trend. We catch the move, and this trend is just continuing. But it tends to happen after a decline for this particular strategy. Take a look at but our 40 is going up nicely. But let's take a look at a downtrend. Downtrend, downtrend, downtrend. Okay. Nice. Okay, there is no argument that would have been a downtrend. It's just lost it here. Let's see where I'm at. Okay. Looking at this, I don't think anyone would argue we're in a downtrend through this whole movement here. Okay. All right, downtrend, downtrend, downtrend. That's clear-cut downtrend. But when do we look for our buy signal? Coming out of the downtrend, one of the first buy signals we're going to have is a Donchian cross, and that's when we know, okay, go long. Now, there are other strategies that would have gotten us into this trade over here. That's the market internals. And another strategy that would have gotten us into this trade over here someplace, which is an Ichimoku strategy. Ichimoku strategy is the one where we use to find market bottoms. So that's what I say for coaching clients. But yes, this would have been our third long trade. The market internals would have gotten us in down here, would have been our absolute first buy, would have been a market internals. And our second buy would have been the Ichimoku strategy, which would have gotten us in somewhere here. None of that is shown in this chart. This is a trimmed down chart for the presentation. So James, yes, it's dependent on the trigger of the setup. And there are multiple short. So in between all these long trades, there's also short trades. Once again, I'm not showing it on the chart here, but there's going to be short trades. There's going to be a short trade here. There's going to be a short trade here. There's going to be a short trade right here. There's going to be a short trade here. There's going to be a short trade in here, another short trade in here, another short trade right in here. I said I'm not showing it on the chart, but I know they're going to be short trades in there too. So we trade this up and down. Even in a massive uptrend, they're going to be short trades where we just capture profits, capture profits, capture profits. And that's the benefit of, so if you go through, I'm going to switch to the spreadsheet because you guys all have access to it also on our website. So I'm going to make sure you know to take a look at it. All right, this spreadsheet is on our website that you can download. It has all the trades over the last couple of years. This is all the trades in 2023 up and through the end of April. Becky updates this on a monthly basis with what trades have either reached first targets or expired worthless and created a loss. So through the end of April, this was where we were at with trades for this year. 97% wins on the short side, 91% wins on the long side, with a total of 86 trades. You're not going to be taking 86 trades, okay? That's not, that ain't going to happen. I've known people who've tried. I've known people who've literally tried to take every single trade, and they end up just making such a mess in their account. They can't manage all the positions, and it just creates errors and mistakes. So you don't want to take every trade, but you try to focus on certain ETFs is ideal and become specialists. If you want to trade oil, trade USO. If you want to trade the material sector, XLB is one of the best to trade. Gold mining stocks, GDX, the NASDAQ is the absolute, of all the major indices, the NASDAQ is the best. So followed by S&P. If you want to trade interest rates, PLT, okay? So if you become energy is one of my favorites. I trade XLE. Here is 2022. 2022 was a challenging year to trade if you didn't have a plan, because you have all these mixes of wins and losses. It came here with the final stats for long trades and short, came out to overall 82% wins. So as long as you're consistent with your trading, you're good. But if you just do stuff randomly, if you just randomly pick things to trade, you might just randomly happen to pick the losing ones. See what happens? You might just randomly pick the losing trades. But if you're consistent with your trading, then it ends up being like what was in the presentation earlier. But yeah, if you're just randomly picking trades, oh, I saw this value, I saw that value, that's okay. But if you're going to be random, you might just randomly pick 1 win and 4 losses. Randomly, it can happen. But if you're more deliberate with your consistency in trading certain ETFs, then you get the absolute best results. But consistency, no matter what, will end up with a winning trading account. 2021 trades, total of 405 trades valid for the options. All right, and here are your number of wins and losses for those trades. Okay, going back to 2020, when everyone was freaking out about COVID and shutdowns, it was one of our best years of trading. One of our best years of trading was 2020. Here are the wins on the long side, wins overall, longs and shorts. 2020 was our best single year of trading. When that market, when everything shut down in the early part of the year, and we had those massive gaps, we had massive gaps. Well, what would happen is that it would the gaps were so big that we were getting 60–70% returns at the very first target. Our options were doubling in value at the first target because the market would gap hundreds and hundreds of points each night. And then when it started rallying back up, it would gap up hundreds and hundreds of points. So it would, if we had like, let's say we had a 2-point target, the market would gap up like 4 points. It would gap so beyond our target that it was gonna be like, wow, you know, where we'd be expecting a 20% return, we got a 60% return because the gap was just so massive. And the more it gaps, the deeper in the money we are. So where we might have normally had a 70 delta, we end up with a 75, 80 something delta option, maybe higher, because it gaps so deep in the money. So then it just gets getting more and more profitable with the gaps. So with this type of trading, more volatility is better. What happens is that as the volatility increases, option prices also increase. So that's not a great thing because now we pay more for the option. But what is a great thing is our target size increases disproportionately higher than the option price is increasing. The option price might increase 40–50%, but our target price might double what it was previously, sometimes even triple what it was previously. So our target got so big relative to the option price, it basically guarantees a profitable trade. It just, the time decay will not be an issue. And our target got so big with the volatility, it just made for some beautiful trading and profitability. But like I said, all of these is 2019. All of this information is on the website. So you can feel free to go and download it. 2019, 94% wins on the long side, 84% on the short side. Same strategies. So this is stuff that you can go and look at. And like I said, Becky updates this every month, and I post it up on the website. And I make this available so that people who are trading the strategies can compare what they're doing and their results compared to what it should be. And I've had some people do a comparison. They realize, wait a second, I might have had a loss here and a loss here and a loss here. What's going on? You know, and then they contact me and we kind of work through it and see what happened. It shouldn't have been a loss. And sometimes it's the user error, and sometimes it's platform error. And there are times when people forget that a good till cancel order is not indefinite. It expires after 60 calendar days. After 60 calendar days, a good till cancel order will expire. So their trade management went away. Let's say a trade takes longer and you just set it and forget it. That's all great. However, you have to keep track of your GTC orders, because if a target is hit, it could gap up, hit your target, and it could be a nice 20-something% return after 2 months, and you thought you had a great, next thing you know, it's expiration and you have a loss. And you go look at it, it's like, why was this a loss? My target got hit. It's because you forgot to renew your good till cancel order. And so when your target was hit, there was no exit order in place. And that happens quite a bit with people who overtrade, and they put so many positions in their account, they can't keep track of them. That's also a thing you learn along the way. But you have to keep track of certain things in your account. And when you see a GTC order expiring, you got to renew it, put it back in, and then you're good to go. All right. So, like I said, we use our strategy to let us know when to go long, when to go short. I usually go through this one. It's an easy one to visually see. And all our strategies are like this. Is usually 2 lines crossing. 2 lines crossing is easy. It crossed. Go long. The orange line crosses with the blue line. Other criteria is valid, which is detailed in the plan, and go long. Here, take a look at this one. It crossed up and then gap down the next day. Here's our entry. And the trade would go against you for a couple of weeks. Okay. So orange line crossed above the blue line, valid. ATR, the $1.35, which puts the target up here. So let's take a look at what happened here. Why it ended up actually being, now when trades go against you for a while, you think it gapped against you, you got in here, it gapped against you, down, 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 down. And when you're down here, let's say you paid $5 for the option. Down here, the option might be worth 50 cents, 75 cents. And then it starts coming back up, but from a lower level. So you think it might hit a target, but it won't be really profitable. You're not expecting much. You might be in the money, but you might make some money, but it won't be profitable. It'll be a slight loss. Then what happens? Gap. That's exactly what happened. It gaps up. That gap up, it just juices up the options with volatility. If it does, remember, option pricing isn't just about one factor. You have all those option Greeks, and that's all that factor is. All those factor in. And
Eversley, you're not sharing the chart yet.
oh, I'm not. Oh, thank you.
Sure.
I'm gonna switch back to the chart. Okay, let me go back to that again. So here we have a trade on SPY in June 2016 up here. Then it gaps down, so your entry is here at the open. Let's say you got in right at the open or higher. But then the market goes against you. You might have paid $5 for the option up here. By the time it's all the way down here, many strikes away, it's probably worth about 75 cents. And you're not really thinking much about it. But then it starts coming back with a gap, and it starts moving higher, and it starts coming back to life. Okay. You may not be thinking much about it. You might not even think about it at all. But then what happens is that it gaps up again, and now you're in the money. So this would have been $1. Okay, $1.35, $2.10. So during this day, after this gap up, is when your target's going to get hit. And this gap up is what fuels it with volatility. And that's part of the option pricing. And it comes back to life. And all of a sudden, it closes at the top, at the high of the day, almost. And you have a profitable trade with the first target hit. It might be barely profitable, but it's made money. So what do? Your order automatically closes out part of your position, and you put your stop loss in on whatever remaining contracts you have, and hope it goes higher. and then it gaps and it gaps and it gaps and goes higher and higher and higher, and your remaining contracts double in price. This is an example of how what you thought might have been a losing trade suddenly becomes a nice winning trade because of gaps, and it just goes higher and you just trailing stops. This could have been a super profitable trade because let's say you didn't get in the trade the next day. Other stuff going on, you got in a couple of days later, maybe. So you got in here. Well, your target is still up here. Your target is still over here. But now you're getting in at several, instead of getting in at 200, 210, 50 something. Let's say you got in a couple of days later at 207. Let's say you got in a couple of weeks later down here at 202. You can get in down here. Your target is still the same. The only difference is your target is now that much bigger. These are the big profitable trades. You don't have to get in right at the open. At or below the open for a call. That's how you end up making more money. And once again, this is all stuff we go over when I'm coaching you one-on-one, is like finding a routine for yourself where you can get the most out of it, have it all fit into your personal personality and time available and everything else too. So this is, try to keep this at a level where everyone can follow, because I know we have a mix of people on the presentation. Do you have any questions? Any questions on anything at all? I'm going to switch back to the handout. And there was a question on profitability. This is something some of you have seen before. One of my coaching clients from a couple of years ago, he was so proud of his results. This is from a few years back, but the percentage returns don't change on options. It doesn't really change the percentage returns. He was so proud of his trading. He actually did a presentation with me for one of the South Bay option trading groups in Sunnyvale. And there was a video of him doing this, but that website's no longer up. So, but this was, he listed his actual real life trades that he did over a 7-month period. And these were his percentage returns. So he risked about $1,000-ish on long trades with calls, and between 500 and 1,000 on puts for short trades. He did a pretty decent job of managing positions, but just want to see the percentage returns is what he had. These were all his real life trades, what he paid, and he was managing first position, first target, second target type thing. So he was getting in part of his position the first target and part of his position the second target. So he did a pretty good job of managing his trades. Didn't make too many mistakes, but you can see how the numbers add up. Okay, it sort of adds up, adds up, adds up. And if you manage your positions well without making too many mistakes, we really don't get too many losses, and that's because it's 80-something% winning trades, and realistically we average 84 to 90% winning trades. Most cases, right about 87 is what we kind of average over a couple of years, 87%. But we rarely get full losses. Okay, here's a full loss. So after 7 months of trading, and I always tell people the best time to trade is October through April. Not because you get less percentage wins, just that you have bigger trends. That time we have bigger trends, so the wins tend to be bigger because of the trends. Between May and September, the percentage wins to losses is the same, but you may not get as bigger wins because the market tends to be more sideways and choppy. But October through April, we get bigger trends, so that's when the bigger profits tend to happen. Nice time to trade. So after, just keep adding up. Now, what was good to show with his account, and it was good that he's done this, because he just was really proud of what he did and wanted to show it off. So he did a presentation with me. If a trade is meant to be a 2% return, it's going to be a 2% return. Don't try to hang on to it. I'm going to move my stop. I'm going to do a little bit. No, it's literally whatever it is, it is. If it's meant to be a slight loss, you take your slight loss. If it's meant to be a small win, you take your small win and move on to the next trade. So here's how his profits and loss added up over 7 months to a ridiculous P&L of 15 or 16 to 1 P&L. So when it's all said and done, after 1 month of trading, a few extra losses, and it kind of came out to about a 5 to 1 return, meaning making $5 for every $1 lost. Here, after 7 months during that perfect time of trading, $16 made for every $1 lost, and then when you factor in the rest of the year, it came out to about a 5 to 1 return. Is a $5 made for every $1 loss, which is just outrageously excellent. So that's a more realistic viewpoint. And he was trading here 1% of the account being risked off a $100,000 account. I say risk 2%. Since he was just learning, he only risked 1%. Once he got it down, then this went to 2%. If it was 2%, this would be 34,000. Okay. So, which is recommended math. Someone might do higher, that's up to them, but that's kind of how the numbers work out. And if you were doing 3% return or 3% risk, then it would be 34, 44, 40, whatever, 50,000, 3 times that on a $100,000 account. But I still recommend this 2% account risk, because you will have losses eventually, and you don't want to mess with your head. The losses will happen, so you doesn't want it messing with your head type of thing. Okay, I'm going to switch back to see a question. How do we know whether to go long or short on market internals trades? In my question, market internals trades is only long. There are no short trades on market internals. So if you take a look at the trading plan, which you have, it's only long only for the market internals. Ogre. So I know you have the trading plan, so take a look through those. It's only one side. All right, so I'm going to switch back to the presentation. Up to now, do we have any questions at all on anything? So I'm going to keep this fairly general, and then if you want more, basically contact me. And if you want to set up a time to chat, I can go through it with you. This is what I do. I work with people one-on-one. If you have some experience with options, then we'd be doing this program. And it's just quickly, I'm going to give you a quickie view of the strategies we go through and kind of what to expect. Okay, once again, these are the symbols we trade, the ETFs, the sectors. These are an example of the stats for one of the strategies, the T lines. 1 expiration cycle, 2 expiration cycles, the difference in time. If we're trading EFA, which is Australia, 80% wins for once. That's basically 1 month of time, but 87% wins with 2 to 3 months worth of time. 83% to 93% wins. Time, the big factor. Spent a lot of time doing GAN, time and price analysis, a lot of time doing GAN, price and time. And if you know how to incorporate price and time with your trading, you can take your trading to a whole different level. So I've always, based upon what I've learned in GAN, time and price analysis, really applied that knowledge to my other trading methods, price and time, not just looking at charts and time. Excuse me, not just looking at charts and price, but charts and time. So when you can combine those two, it gets really powerful. Okay, so this is one of our trading strategies, 2 of them, the long and short. This is the long side. Here is the short side. If it's in light blue, it means it's 84% or higher. That's all we look at. If it's 84%, if it's 83% or lower, we don't deal with it. So if this strategy became valid on the short side on FXI, which is China, we would pass because it's only 83%. But if it became valid on GDX, which are the gold mining stocks, 94%, great opportunity. GDX is one of our favorite things to trade. Pricing is right, options, open interest is great, and of course the Qs. Right, another one of the strategies, our hook strategy. This is part of that first option plan, so you can see what the percentages look like for win-loss for the different ETFs. if an EWG with Germany became valid with this strategy, we would pass because neither one's is 84% or higher. But if it became valid on IBB, which is biotech, we'd be doing 2 expiration cycles, not one. So this is how we know how much time to get. If it become valid on NASDAQ, we have a choice. But this is how we determine how much time we need in the option to have a successful trade, because Becky maintains these numbers, so we know. Another one, this is the one we use for market bottoms. This is one we use to find when markets are turning up from the after every decline. This will be our first buy signal. So this is the one we use after every decline. This is our first buy signal, so we know which ones to trade. Always what we look for. This is the one we use for market tops. After every rally, doesn't matter if it's a massive uptrend, sideways, whatever, after every rally, the market will generate one of these signals, so we know exactly when to go short. Every market generates this trade signal at a top after a rally. We know when to go short. This is how we know how to get market tops. And when we do market tops, it's beautiful because we're getting in short when the put options are really cheap and volatility hasn't juiced them up yet. And then some of the weekly chart strategies for the strategies, the same sectors, except we go off weekly charts. So basically we just work on weekends. Some people don't want to do stuff from day to day, just want to work on weekends only. So those are the win-loss percentages for some of the weekly strategies. So anyway, that is what the different strategies look like. I'm going to go back to the share. And okay, so if anyone's interested in working with me on these, call me or email me later. I will take $100 off this price for $16.50. Let me know before this week is over. This is on the website, is also in the handout. And I do everything with people one-on-one. I don't do groups. I will help you set up all the charts. I will help you. All the charts I showed today are on NinjaTrader. They can also be done on Thinkorswim. Some of them, depending on if you want to do your own platform, is up to you, but you should at least make sure it matches our charts. It was a couple of indicators that are pretty much standard out there now, so it shouldn't be a bigger deal for the options and ETFs. If you want to set up your own charts, just make sure the settings give you the same signals as we have, but I will help you get everything set up. I will literally hand you the charts for NinjaTrader. I will hand you the charts for Thinkorswim, so you don't have to recreate them on your own, unless you're doing a totally different platform, then you have to recreate them, but it's only 3 indicators, so not that big a deal. So I will help you set everything up and meet with you. We'll get a plan put together because it has to fit your lifestyle and time available and financial reality. Okay. We update the stats every 3 months. And for the first 9 months, I will email you each night what trades are valid. So you can compare what trades you found valid with what trades we found valid. Okay. You want to commit to at least 3 to 6 months of trading the strategies. And that is so you can go through all the wins, the losses, the ups and downs, the highs, lows, the emotions, to really understand the profit and loss situation and find a way that managing positions work for you. You might think, yeah, I want to do first target, second target, third target. I want to do all this. And then when you're in the heat of it and you got 20 trades on, each with 3 different sets of positions and contracts everywhere, you realize you're lost in your own account. It's just way too much. So that is a reality also. So you have to, those first 3 to 6 months is when you figure out what really works for you and your day-to-day lifestyle. So if you get overwhelmed with trades, you just can't do it. You're going to end up making mistakes and losing money. So you got to find your sweet spot. So I work with you during those first months to really fine tune what works. Either meet with you in person or on Zoom. I like to meet people in person if at all possible in Santa Clara. That's my preference. It normally takes 5 to 7 hours to learn the option strategies. But everyone's different. I've met with people I've met with for 2-3 hours, never saw them again. Literally never saw them again. And I met with people who we meet for 2-3 hours every weekend for a couple of months. So whatever it takes, it is fine. I'm really very reachable via email for any questions, and or just give me a call. So I'm always very available. If you've never traded before, I will help you set up your account. I will help you get everything just right. If you've never ever traded, I can work with you on that. I got a program for people who have never traded before. It requires more of my time. I will take $500 off this price for people who this is for everything. This is for the daily chart options, which we just saw, the weekly chart strategies, plus the market internals. This is everything. And for this price, I also take $500 off this price. And also for people who are brand new to trading, who need more of my time, also this is the approach. So you can read through this. But I really will handhold with you. I will literally, there are people who have literally been sitting next to when they're on their phone with their broker, going through the setup of their account, and also sitting with them in person as they are placing their very first trade and managing it, because they needed a second human being help them, and they preferred me being literally physically there with them as they push the button, not on Zoom, but physically there with them. And I had no problem with that. As long as you can meet me in Santa Clara, we can do that. So whatever it takes to get you trading, and that's what we'll do. All right, so is the current market showing top using a strategy? Is the current market showing top? A question from James. Which market? We're talking S&P or a different market? You're specifically looking for S&P or something else, James? And I'll answer that question for you. We'll take a look at it. Yes, the question is the current market showing top using a strategy. We have gold, we have oil, we have natural gas, we have home builders, we have real estate, we have NASDAQ, Dow, S&P, Germany. So tell me the market, and we'll pull the charts up and take a look at it if you want. All right, so if you don't have any more questions, then I'm going to go ahead and end it here. We'll probably have another meetup in 2 weeks, and good chance we'll be doing futures in 2 weeks. We haven't done futures in a long time. We've updated some of the strategies, and we're going to probably focus on one that's for shorting the futures markets, and specifically currency futures. Currency futures we've just had consistent success with forever. Like I said before, in last year, futures were a little bit off for us, but not the currency markets. The currency markets were still profitable. So it's been really good for us. So we've been enhancing the currency futures strategies for even more profitability and more trades. But like I said, we'll meet in probably 2 weeks. I'll send it out. And if you want to work with me on this, let me know. I'm usually available several afternoons each week, evenings by Zoom, and Sunday afternoons I'm usually available to meet with people either in person or via Zoom. So Sunday afternoons, Monday, Wednesday afternoons, Tuesday mornings, sometimes late Tuesday afternoons, and sometimes Friday afternoon maybe, but definitely Sunday afternoons, all evenings. And most evenings I'm available via Zoom. And like I said, we'll work with you one-on-one, get it all set up, get you trading, and try to get you trading live as quickly as possible. If you already have some experience, we can get right into it and fast and fine-tune this. This part of the year we really want to be ready for is a little bit later in the year. So if we get everything fine-tuned now, then when we get to that later part of the year around September, October, that's when the money starts getting made for the bigger trends. So, but if we get everything in place now, work out little details now, we'll be ready to just start clicking later in the year. So no questions. Let's go ahead and end this meetup, and I'll probably schedule one for about 2 weeks from now for futures, and we'll take a look at some of the future strategies. And I hope to hear from you guys soon. Call me with any questions. Email me with any questions. My information is on the website and in the handout. And if you want a copy of that P&L sheet from those trades from one of my coaching clients, just let me know. Email me and I'll send that to you. Otherwise, I'll be in touch with you guys soon with the updates. I'm going to make this video is being recorded, so I will send that out a little bit later on. All right, see you guys in 2 weeks.